How to invest with lower risk and better returns. One way to achieve this is by identifying companies with high barriers to entry. But what exactly does this mean? You may think of the business as a fortress, but instead of a moat filled with water and crocodiles, it's filled with regulations, technological knowledge, patents, long-term contracts. Those protect the business from new competition and ensure the profits are predictable and stable. These moats not only strengthen the company's business model, but also offer predictable profitability, higher margins, and often lower risk for investors. In a nutshell, when a company has high profit margins, competitors want to enter the same market. The purpose of the high barriers to entry is to protect the company's business by making it difficult or expensive for rivals to enter the market. So how to identify high barriers to entry? Typical barriers to entry that prevent competition and protect companies from price competition include, for example, industry regulations, geographical barriers, technological barriers, patents, niche markets, high market share barriers, high capital requirements, accumulated knowledge barriers, and long-term contracts. Let's take a look at some real-life examples from businesses we have invested in the Sifter Fund. The first example is Canadian National Railway, a North American freight train company. Canadian National has built an extensive rail network spanning over 30,000 kilometers in North America, connecting 3 oceans. It is highly unlikely that competitors would build any rail networks or infrastructure in the same areas, making it difficult for new competitors to enter the market. The second example is from the aviation industry. Safran is a French aircraft engine producer whose engines are used in Airbus and Boeing planes. The aviation industry is heavily regulated, and all parts and suppliers used must have passed heavy testing by multiple regulatory agencies. Thus, it's very difficult for new competitors to enter this highly regulated market, and market entry would require a huge amount of time, capital, and expertise. In addition, Safran has a large portfolio of patents and intellectual property, as well as long-term contracts with multiple airline companies that provide a stable source of income, making it difficult for new competitors. If you want to hear more about quality investing and its principles, please visit sifterfund.com.